Hey everyone, welcome back to Thanks for tuning in. My name is Mike and this is my whiteboard, and today we're going to be talking about 3 things to know about USO. So there's an opportunity in the markets, and for us, we like to look at energy at these levels. We've seen all types of energy products get beaten up. USO is trading at their near lows, along with all the other oil products and natural gas products. So this is something that we want to think about, and this is really going to be a deep dive into USO specifically and whether or not it may be a viable long-term product. So we're going to be looking at 3 things for USO today. The number 1 thing we're going to look at is where it's trading at right now. The number 2 thing is we're going to look at the genetic makeup of USO, which is really important. And lastly, we're going to compare it to some other underlyings that may or may not be better. So let's dive right into the chart on the next slide, where we're looking at USO over the last year. So as you can see, USO has taken a tumble all the way down to near its lows. I think it's trading around 9 points right now. And the 52-week low was about 792 with a high of 2150. So over the last year, USO's price was almost more than double, almost triple where it is now. So we're trading at about 9 points. And now what we can do with this information is really decipher where our opportunity lies. And at the end of the day, that's going to be up to you, whether you believe the oil markets are still due for continuous downtrend, or maybe you think they'll bounce from here and come back up to somewhere around the highs or somewhere in the middle here. But what's really important is to establish an assumption. So when we're talking about getting long products or getting short products, regardless of what that is, it's really important to understand what the product is that we're actually trading. So USO is an ETF that basically tracks the CL curve and the CL futures, and it really looks into the futures products as opposed to physical. So let's go to the next slide here and we'll talk a little bit more about USO. So let's look at the genetic makeup here. The fund seeks to replicate performance of WTI light sweet crude oil, less expenses. So what you can do if you don't understand a product or you don't know what the product actually is just type it into Google. All I did was look up USO. I think I found this on either the NASDAQ list or the CBO listing, but even Yahoo Finance, really anything that has all the products listing and the actual makeup of the product, what you'll see is a description like this under the profile. So the number 1 thing I looked at was what it seeks to replicate. So yes, okay, I've got crude oil here. I know that crude oil has been beaten up. I believe it's trading right around 30 points for the futures contract, and it was over 100 points just a year ago. So I know that for me, that might be an opportunity to the long side if I'm looking to get long here. Secondly, and most importantly, this fund invests in futures contracts as opposed to physical product. So there's a reason why this is important. So when we're looking at the genetic makeup of a certain product, whether we're looking at a physical product or a futures-based product, it's going to differ and change the way that that product reacts. And all of a sudden, instead of being invested into physical products, just knowing that it's investing in futures contracts, and it must be a portfolio of futures contracts that's constantly balanced because time happens and we go from month to month to month. So one futures contract will expire and we'll have to roll it into the next month, and we'll have to do the same thing here with USO. So it's really important to understand the genetic makeup, and with futures contracts specifically, the futures curve of CL, which is the number 1 player in USO, is going to either drag or drift the price of USO depending on what that futures curve looks like. So we're going to dig a little bit deeper into that on the next slide here. So when we're looking at drag and drift and how that affects USO, specifically with the futures contracts of /CL, all you need to know is that negative drag occurs when the CL futures are in contango, and positive drift occurs when the CL futures are in backwardation. So contango and backwardation are pretty heavy terms, but they're really simple to understand if you just dig into them. So really, when we're looking at something being in contango or a futures curve being in contango, really all that we want to see is that the front month in red is less expensive than the back month. And if we just reflect on what these terms mean, front month and back month, when I'm looking at a front month, I'm looking at the actively traded month. So the next possible month I can be possibly trading that's active is going to be considered the front month here. And the back month is going to be just one past that. So right now, if the active month or the front month is, let's say, January or February, depending on the active month, let's call it January. So let's say it's January and we're looking at the back month, which would be February. Or if it's February in the front month and we're looking at the back month, that's going to be March for the back month. So just understanding the front month is the actively traded month and the back month is the month just after that, it's going to give us a better idea of what this means. So when the front month is less expensive than the back month, this is what would be considered a futures curve that's in contango. And the reason why this is important is because, like I stated before, if I know that USO is looking at futures products and has a portfolio of futures contracts that's constantly balanced, if I roll my front month into the back month, so let's say I've got a bunch of February contracts, whether there's a weight between February and March or not, it's probably going to be heavily weighted towards February. So let's say I've got all these contracts in February and I'm looking to roll all of them or most of them into the back month, which is going to be March. So I'm going to have to constantly be doing this to balance the portfolio. And in doing so, if the front month is less expensive than the back month, basically if I have a set amount of dollars that I can be working with, and I have to close out of my front month futures that are less expensive than the back month, I'm not going to be able to get that same exposure in the back month futures because I'm not going to have that same amount of buying power available. So let's say I've got $100,000 in a mock account and I'm looking to close out of my front month and roll them to the back month. Since the back month are more expensive, I'm not going to have that same exposure as I would if I were, let's say, just owning one futures contract and rolling it to the next month. Yes, I would still have a cost of carry if I owned one futures contract and rolled it to the next month. So if I've got a February CL contract and I roll it to March, I'm going to have to pay to roll that, but I have the same exposure. I would have $1,000 per point in increase in CL for February as I would for March. So my exposure stays the same. But if I have a fixed income and I have a fixed amount of capital to use, if I'm closing out of the front month and rolling it into the back month, my exposure to that product is going to drag down, which is going to decrease my exposure. And if that same 1 point increase happens in CL, if I now have less contracts available to trade that with or less contracts in my portfolio, I'm going to have an underperformance. So that's really what's important when the futures contracts are in contango. Now let's talk about what happens when they're in backwardation, which is really just the opposite. So this happens pretty rarely with CL specifically. You'll normally see the futures contracts in contango with CL, but if they're in backwardation, what's going to happen is that I'm going to have more expensive front month futures than I would in my back month. So I would have, let's say, a surplus of contracts here, or basically if I have a certain amount of contracts here, I can now get more contracts in the back month, which would give me a heightened exposure than I would normally assess. Or if I'm looking at just the futures contract, if I'm going from front month to back month, I have a 1-to-1 exposure. But if I've got fixed assets in the front month and I roll it to the less expensive back month, I can now have more exposure. So what you'll see is that when the CL future curve is in backwardation, you could see an outperformance of USO products that are based on the futures curve. And when CL futures are in contango, you might see an underperformance. So let's go to the next slide here and we'll drag this all together and see what happens when we look at USO specifically and compare it to some other products. So, long-term investment. Could USO be a good long-term investment? If we assume that CL is normally in contango, which would drag USO down, it may be a questionable long-term investment. So this is something to consider. Maybe if you didn't understand what USO was made up of or that it was based on futures and constantly balancing those futures, it might be easy to overlook these things. We do have alternatives though. So if we're looking to get long USO here, and Not saying that you should or shouldn't, but if we have an opportunity and I've got an IRA account, maybe I just want to get long some shares of oil products and see what will happen in the future, it might be not a great long-term investment when I look at some other alternatives. So I do have alternatives that could give me close to the same exposure that are going to have these pretty high correlation when it comes to the correlation between these products listed here and the CL futures, which we're all looking at these days. So I might be looking at XLE, which is an energy ETF, or XOP, which is oil and gas exploration, or even CVX, which are Chevron, and XOM, which is ExxonMobil. We both know those brands. So it's really important to just clearly understand what we're looking at with our futures contracts and specifically with the products we're trading. So I now know that USO is based on constantly balanced futures in CL, and for that reason, it might create drag if the futures contracts of CL are in contango, and it might create drift, a positive drift, if they're in backwardation temporarily. So now I know all about USO. Now I just need to make the decision if I wanted to get into the oil market, whether I want to go with USO or if I want to go with one of these alternatives here. So let's wrap all this together with some takeaways. So the number one takeaway is that USO is a futures-based ETF. There are other ETFs that are not futures-based, they're physical product-based. So if you look at things that are looking at gold or silver, a lot of those products are going to be physical-based. They've got the physical bars of gold or silver, and they're basing their future value off of that. But with USO, since it's a futures-based ETF, it does have the effect of drag and drift based on whatever that futures contract that USO is looking into will have. So USO is at the mercy of the futures curve. So it's really important to understand the futures curve, understand what the product is that we're looking at here. So with USO, mainly I'm going to be looking at /CL and determine whether that's in contango or in backwardation. When I've got drag, it's usually going to give me an underperformance compared to the product. So if I'm looking at CL and I'm rolling into the next contract with just the futures, yes, it's going to give me a cost of carry. It's going to cost me something to do that, but I still have the same amount of exposure. Whereas with USO, I would usually have a lesser exposure because I'm going to have to pay more and constantly rebalance that portfolio, which can give me an underperformance. On the flip side, if the CL futures are in backwardation, I could have just the opposite effect. So if I see that they're in backwardation, I might see a positive drift and potentially an outperformance with USO in that case. But lastly, and the biggest takeaway here, is to understand your product. So this is something I didn't know when I first started trading. I was trading USO. I had a covered call, I believe, until someone really told me about how USO was made up. And the genetic makeup is so important that, as you can see here, it can totally change the P&L for owning this underlying or shorting this underlying. So really the number one takeaway here is to understand our products, and it's really going to help us trading in the long run. So thanks for tuning in. My name is Mike. If you've got any questions or feedback at all, shoot it over to support@doe.com or or you can shoot me a tweet at DoeTraderMike. But the shadow traders are next, so stay tuned.